Hello, everyone.
Hello.
Is everyone doing okay?
Yeah, doing great.
Nice. Okay, then we will move on. So, first, I will take any questions you have. Then I'll go into one or two concepts which I need you to understand well. And then we will get into uh, the flexible budgets. Depending upon whatever time we have, we'll try to do that. Okay, the floor is open for you guys. If you have anything you would like to share or ask questions on, please do so. Okay, hearing no one from anywhere. When we did the master budget, we said, okay, we were talking about Holiday Inn, for example. And at this time, you should be able to see a Excel screen.
Yep.
So when we said Holiday Inn, we had, say, 500 room property, and our occupancy was, say, eh, 80% occupancy, and room rate was, say, $100 per room night, right? Let me just do it a little bit differently. So that it is clear what I'm writing. So let's say room rate was $100. This was occupancy percentage, and this was number of rooms. If you remember, that's what we did in the master budget, right? Now, this was what was budgeted or which we thought was the standard for us. You know, when the actual situation takes place, it will be different, right? So basically, the room number of rooms occupied on a daily basis, we are expecting for the month of, say, whatever month is, 400 rooms. Now, actually, the occupancy percentage is, say, 70% only. That means our number of rooms which were occupied will be 70%, 350 rooms. And maybe we only got $95 on an average as the room rate. This is actual, right? And I again made up these numbers. So this is actual. The number of rooms still remain at 500. And these are the actual scenario. Now, if you notice that if you compute the room revenue, your budgeted room revenue was 40,000. Your actual room revenue is 33,250. Now, is this variance favorable? Variance means the difference between the actual and budgeted. Is this variance favorable or unfavorable?
Unfavorable,
Unfavorable. Why?
because you made less money than you projected you would.
Okay, very good. Now, let's assume that the cost of housekeeping in those rooms was budgeted at, say, $20 per room per day. That means total cost of housekeeping for 20 rooms was budgeted at $8,000. Your actual housekeeping was at $23. That basically means your actual cost of housekeeping will be $80.50. So in terms of room revenue, you said it was unfavorable because your because your actual was less than the budgeted, right? That's what you're saying. What about the cost? Is cost favorable or unfavorable?
The cost for the projected would be favorable, and for the actual is unfavorable.
Cost for which will be favorable, you said?
The projected would be favorable compared to the actual.
Why is the projected cost favorable than actual?
Because it's less.
So that is what we said that it should be, right? So how would we compare it to? We would compare it to actual. The budget really doesn't make any difference to your cash, right?
No.
So instead of $20 per room, you spend $23 per room per day. So is that favorable or unfavorable?
That would be unfavorable.
Yeah, unfavorable. So your cost is unfavorable when actual is more than the budgeted, right? So your revenue is unfavorable when actual is less. So you notice the difference between the cost and the revenue? They work opposite to each other. They are opposite in nature, right? You know that from 201 also. Any questions until here? Okay, I'm going to come back to this again And then we will discuss what is meant by flexible budget. I'll come back to this in a minute. Now, before I go back to it, let me ask you another question. Suppose you are going to buy a car, say Toyota Camry, and your budget was say $25,000. However, when you actually went to the market, you ended up buying a Tesla for $40,000. Is your variance favorable or unfavorable?
Unfavorable,
Unfavorable? Why?
because you spent more money than you budgeted for?
So in this case, you spend more money than you budgeted for. But did you buy what you budgeted for?
No,
Okay, so should you compare the two?
I would say no.
Pardon me?
I would say that like they're uncomparable because they're two different cars.
They are two different cars altogether, right?
Yes.
So you cannot compare the budget of one to the actual of another. So you probably needed a budget for Tesla, let's say 38,000 or 35,000, whatever the number is, right? Then you can say, yeah, you have got a 2,000 unfavorable variance. So in this case, this $38,000 is what we call is the budget for the actual level of activity. See, actually you bought one Tesla, that's the budget for it. Now, when you compare these two, it would make more sense to compare it rather than comparing 25,000 to 40,000. Okay? Does everyone understand this example, please?
yes,
Okay. So over here, we have got three numbers. One is your budget, one is your actual, and one is your budgeted for actual level of activity, right? When you find the budget for the actual level of activity, it is referred to as flexible budget. This is not a perfect example. I'll give you one or two more examples, but this is just to drive the point home. Once you understand this concept, everything will become very simple. Now let's go back to this example. Now, should you be comparing this with this?
Yes. I think so.
Think again.
Would that be a no? They shouldn't be compared?
Give me the reason.
I'm not entirely sure. I'm not sure. I'm just trying to understand where you're going.
Just think of it this as, say, a Camry and a Tesla and a Camry. So actually, you only sold 350 rooms, right?
Yeah.
Right.
So you should compare it with the budget of how many rooms?
350?
350 rooms, right? So you should be comparing it with a budget of 350 rooms. Only, right? So in this case, your revenue would be 350 times 100. Same thing here for your cost. It should be 350 times the budgeted cost. So this is budget for the actual level of activity. Do you see that?
I'm kind of confused.
Pardon me?
I'm kind of confused.
Okay.
Like, I'm just a little confused on like why they wouldn't be comparable if they're under like the same category.
Okay.
And then also why you multiplied it by the budgeted, um, like budgeted
Okay.
housekeeping
Okay.
rather than
Let me continue with this example of Tesla. Okay. Suppose you budgeted to sell 400 Teslas. And you ended up selling, say, 350 Tesla only, and actual price was, say, 40,000. So you had a budget of 1,520,000, I guess, or 15,200,000, sorry. But you actually had a revenue of 14 million. Now, is this variance favorable or unfavorable? Did you do well or did you do badly?
I would say badly because it's a lot less.
I would think it would be favorable because you saved money on your actual compared to your budget.
Were
What
we
is,
talking about selling Teslas and not buying them at this point?
uh, yes, I said, yeah,
Yeah,
you sold Tesla. This is revenue, I guess.
Oh, I thought we were buying. My bad.
We can do the buying also. It doesn't really means it would be opposite of selling. I know where the confusion is coming from. I'm still trying to, let's just make it clear. Say you're buying it, just do it for cost right now. Okay. So you were budgeting to spend 15,200,000, but you ended up spending 14 million instead of 15 million. So is this favorable because you spent less than the budgeted?
Yes.
Yes.
Hmm?
Yes.
Why?
Because you're saving money.
Are you really saving money?
Well, you're not really saving money, but you're spending less than what you budgeted,
And
and that's favorable.
I would say no, because you need to compare at the 350 at the 38,000. In which case you would have been spending more than you would have budgeted for that level of activity.
so you see the confusion here? So if I compare it, I was going to spend $38,000 only, but I spent 40,000, and but overall I spent less. Is that if I just was doing one car? So if you think we saved money here, then that means even if it was one, it should be favorable for me, right? But it is not, right?
Right.
Right. Because I'm just a little confused. Is that because like the price per like unit is lower? You're
Yes,
just okay.
because there is a difference in the price, because I budgeted less by 2,000. I actually spent more by 2,000 for every Tesla.
So we should like make another column and do 350 times 38,000 and then compare that to the actual.
Yep,
Okay.
that is what the flexible budget is for.
Okay. That makes sense now.
So when you have to compare, you will need to compare 350 with 38,000.
Okay, and just to double check, the row that says Tesla, that's like the price for the Tesla?
Yeah.
Okay. I think I'm starting to understand now.
Oh, sorry. I should have given the number here and cost here. Number of Tesla and cost per Tesla. Okay. Now, the reason why you had this confusion was because one, the quantity was different, right? And the second, the cost per unit was different. So if you think about the difference between these two items, that is 15,214 million, which is a difference of about 1,200,000. So the variance, the total variance is still 1,200,000, but it is due to two reasons. One, due to the quantity being less, and the second, the cost being more. So for our decision-making purposes, we need to separate the reason for quantity and the cost. Questions, please. Think about it for a minute. I'll join you again. Give me about 2 minutes. Think about it and think of any questions you have for me before I proceed forward. Because once I proceed, then I don't want to come back to the concept again, but I need the concept to be clear. Okay, any questions, please? Any doubt, debate?
No, I think it's cleared up now.
Okay, so similarly over here, we are just doing it. We are preparing the budget for the actual level of activity. Okay. I'm going to give you one more small example, and then I'll move on to the chapter. Suppose you sell orange juice and in bottles. So your budgeted output is say 20,000 bottles. I'm making these numbers up as I'm going. I'm not, means it's not going, numbers are not going to make any difference at this point of time. So, but your budgeted output is say 20,000 bottles of orange juice. And every bottle, come on, uses up, say, 10 oranges. These are the budgeted numbers. Budgeted or standard number, kind of. The standard is basically for every bottle of orange, you use 10 oranges. It cost per orange is say 20 cents. So the total number of oranges needed or budgeted is 20,000 times 10. So we need those many oranges. The cost of oranges is obviously then 20,000 times 0.2, $40,000. Okay. Now, coming to the actual, you ended up using 24,000 oranges, and the cost of orange was, you made 24,000 bottles, and then you ended up using 210,000 oranges at a total cost of $44,000. There's something wrong here. Okay. that's the information given to you. So basically, how many oranges were used in every bottle? You used 210,000 oranges, you produced 24,000 bottles. So every bottle used up 8.75 oranges, uh, kind of 9 oranges. Okay. And what was the cost per orange? You had 44,000 oranges. You used up 210,000 oranges. So cost was about 21 cents. So if I kind of $0.21. Okay. Is everyone with me, please? So as far as the budget is concerned, there is no issue. As far as actual is concerned, there is no issue, right? But when we come to the flexible part of it, that is where we need to find out what is the actual level of activity. The actual level of activity is 24,000, right? And we need to find out for those 24,000 oranges, what should have been the budget, right? Before we make the comparison. And we also know that the variance is due to the two reasons, quantity and price or cost. In this case, I really will be using the word price, but that is price of the buying the orange, more in that terms. Okay. I know that price means selling price. Okay, so when I say price, it is price of buying that thing. Okay, or the cost. So we know that the difference is due to two reasons. One, due to the cost, and the second is cost or kind of price. I don't want to mess it up. And the other is due to the quantity used, quantity. So actual price minus the standard price or the budgeted price. If you notice over here, your actual price per orange is 21 cents and the standard price is 20 cents. So what are we saying over here? That your cost per orange or price, whatever or cost we bought it, we budgeted for 20 cents, but we actually spent 21 cents, right? Is everyone with me still?
Yes.
So in this case, the price that we paid is more than what we budgeted for. And we paid that price for 210,000 units of oranges. Yes. So this price of 1 cent for 210,000 oranges is basically unfavorable. So price is more than we budgeted for. Any questions on this, please? Also, when we are doing the variances, we are not going to do favorable or unfavorable. We'll be doing the U for unfavorable, F for favorable. Because if you change these numbers around, then again, you should understand the interpretation. Sometimes you might end up writing standard price first and actual price later. So that will change the interpretation. Next one is actual quantity used minus standard quantity allowed for actual level of output. So your actual quantity in this case used was 210,000 oranges. Standard quantity allowed for the actual level of output. Your actual level of output was 24,000. Standard quantity allowed was 10. That's the flexible budget part of it. For the standard price. So in this case, you had actual quantity used was 210,000. Your standard quantity allowed for that level of output was 240,000. So you used less quantity than you were allowed or budgeted. So your variance is favorable based upon that for the, and this is true for the standard price of 20 cents. So this is 6,000 favorable. Ignore the minus sign here. This is 2,100 unfavorable. There's something wrong somewhere. I think it's a rounding up error somewhere here. It's not exactly 44,000. I'm getting a rounding error of $100 due to this. Means the concept will still remain same. Concept is not changing. I've made a calculation error somewhere because this should, because you got a difference of 4,000 here. Basically what I'm trying to do is account for this variance of 4,000. So 6,000 favorable and 2,100 unfavorable. That is basically gives me the 4,000. So there's somewhere that rounding up error is coming. And that is creating a problem for $100. So you got like, I still have a rounding up error, but I think I can drive the point home. It's not a problem. So you need about a $4,000 total variance is there. And that 4,000 is explained by 6,000 of favorable variance and 2,000 of unfavorable variance. So total of 4,000 favorable variance. That's basically what it wanted to show. Okay. So I'm getting a rounding up error here for $3 or something. I'm pretty sure if I play around with the numbers, I'll be able to get the exact one. Okay. So what I wanted to show you here was this computation of standard quantity allowed for the actual level of output. You need to understand that part. Does everyone understand the computation of 240,000? Okay. As long as you understand this part, I'm good to go. Any questions before I proceed to the chapter now? You should be able to see the PowerPoint at this point of time.
We can.
Suppose you are using a fixed budget and you compare it to the actual results. Means if your sales are more than your, if your actual sales are more than your budgeted sales, you've got a favorable variance. If your cost is less, if your cost is more than your budgeted cost, this is unfavorable variance and so on. So that is basically you're comparing a Camry to a Tesla kind of a situation. Because over here, if you notice your sales in unit were 10,000, but you're comparing it with an actual sales of 12,000. So when we prepare a budget for different level of activities, say in this case 10,000, 12,000, 14,000, this is called a flexible budget. So we use the same assumptions that were there in the master budget. So if it was $10 per unit, for 10,000 your sales are 100,000, for 12,000 and 20,000. We use this to do a sensitivity analysis as to see what is going to happen if our sales are over the budget or below the budget. Same thing means if you look at the fixed cost, these are remaining same across the board. The variable cost per unit is changing. So this is flexible budget for a different level of sales activities. So when we do the flexible budget, I don't know whether you can see this or not, but suppose your actual sales were 12,000 units and you prepared a budget for 12,000 units. Now you can compare the sales. So this is like a sales variance. You have got 5,000 favorable because you sold more. In the direct material, you were allowed 12,000, you spent 13,000 actually, so you are 1,000 unfavorable. So flexible compared to the, then what we have done further is that for for direct materials, this variance of 1,000 might be due to price or due to the quantity used. It could be due to two different reasons. So we segregate those variances for that reason. Same thing with the direct labor. You got 18,000 in flexible budget, 20,000 in actual results. So your actual cost is more than the budgeted cost. It is unfavorable variance. Now we will then further segregate this 2000 into due to the price as well as due to the quantity. And it goes the same way for all of those. Any questions here, please? Now, how do you define standard cost? Basically, if you talk about the standard cost, what it is basically a preset cost for delivering a product. And same thing, uh, they are they are basically established due to the past experiences or any engineering studies that you are doing. We have generally a standard for material that will be used and for labor and overhead cost. Overhead cost could be both variable and fixed. So for direct materials, you can have price standards or the quantity standards. So in the price standard, we had 20 cents per orange was the price. Quantity was 10 oranges per bottle. So that's basically what we are saying. Direct labor, we could have added the direct labor and the variable overhead also similarly. And we'll do that over a period of time. So here is an example of a standard cost. For example, it takes direct material of 1 kilogram of wood at a cost of 25 kilogram per kilogram, 2 hours of labor at cost of $20 per labor, and overhead at 2 labor hours at $10 as the labor overhead rate. So your total cost, standard cost is 85. And then these standard costs will then be used to prepare the manufacturing budgets for a budgeted level of production. Just stop me wherever you have questions. It's nothing that I'm trying to rush through it or anything. If you have questions, just stop me. But I've explained many things already. So, so as I said, if actual cost is more than the standard cost, it's unfavorable. If actual cost is less than standard cost, it is favorable variance. For sales, it would reverse. So when we do the variance analysis, we prepare a standard performance report. It is, you compute the variances. The reason for computing the variances is to identify why, what can be changed, what can be improved, who can be held responsible. So in the last case, if instead of 20 cents, we bought it for 21 cents, every orange, should the purchasing manager be held responsible? Or is that offset by the quality of oranges that we had to use less oranges than budgeted? So that's the reason to segregate the variances, to pinpoint where the responsibility lies. So we have got the actual cost times the actual price, giving you the cost, and you compare it to the standard cost times standard price. That is, this is based upon your master budget. This is your actual. The variance between the two is the total cost variance. Now, please note down these definitions. Actual quantity is the actual amount of material or labor used to manufacture the actual quantity of output. Standard quantity is the standard amount of input for the actual quantity of output. Notice this is the flexible part of it. Actual price is the actual amount paid. Standard price is the standard price. So this is the only thing that you need to make sure that you pay attention to is correctly stated. Any questions here, please? Means I'm just showing you the slides this time to just re-emphasize whatever I said. I can move into the problems directly at this time. So as we said, the variance is due to two reasons, the price and the quantity. So the first one is due to the price. So actual quantity times actual price is the first one, which is actual. Actual quantity times standard price is your flexible. This is your flexible. This is your budgeted or the master level. Standard at standard. This is actual at standard, actual at actual. So if you take out actual quantity common here, it will give you actual price minus standard price in the bracket. Same way here, if you take out actual quantity, if you take out the standard price common, then you got actual quantity minus standard quantity. It's the same thing that I've shown you earlier. It's written the same way. Make sure everyone understands this part, please. Any questions, please?
Nope.
And this is the crux of everything that I already told you. Make sure you understand both of these formulas very, very clearly. And the reason for doing it. So I've explained to you until this slide already. This was just a repetition. Are we good here, please?
I think we're good.
So let's take a small example. Direct material is half a pound per unit at $20 per pound. Direct labor, 1 hour per unit at $16 per hour, $16. During May, 3,500 club heads were produced using 1,800 pounds of material, paid $21 per pound for the material. So what you need to do is compute the material price and the quantity variance. This is already given to you, half a pound, $20 per pound at $10. Any question on this information, please? Now, here I'm going to tell you the code word for doing all the problems in this chapter. Write down the formula. Write down the formula that price variance is equal to actual price minus standard price times actual quantity. Same thing here. Write down that formula and fill in the numbers. Is everyone clear?
Yes.
So write down the formula clearly and fill in the numbers. That's about it. And the chapter is over. I can prove that to you now. Here it is. 21 minus 20 times 1800 gives you 1800 unfavorable. Why? Your actual quantity is more, sorry, actual price is more than the standard price by $1. Same thing here. The standard quantity allowed is 1750. Actual quantity used was 1800, so you used more than what was allowed. That's why the variance is unfavorable. Okay. This. Any questions here, please? So the total direct material variance is 2800 unfavorable. You add both of them. Why is it 1000? So 500 times 20, yeah, 1000. Okay. Okay, any other question, please? That is who is responsible, which I also discussed earlier. Now, when we talk about the labor variance, everything remains same, except that the price is replaced by the rate and quantity is replaced by the hours. Same formula, except that the price is replaced by the rate, because you pay, when you say the labor rate, that's what it is. This is the price. And instead of quantity, we call it hours. $20 per hour is the labor rate, right? So that's the difference. This is called the rate variance. This is called the efficiency variance formula. So again, same concept, write down the formula. Do not short circuit the process. Write down the entire formula and fill in the numbers. It will take you much less time. As you read the problem, write down the formula and start to write down the information. That's it. There is nothing much to be done here. So again, the same information, you use 3,400 hours at an average rate of 1650 per hour. This was the standard. So you do the same thing. You paid more by 50 cents for 3,400 hours. So your unfavorable variance of 1,700 over here. Standard hours allowed were 3,500 at the rate for 3,500 units. You use 3,400, so this is favorable because you used less hours than what were allowed. You used 100 less hours at $16 per hour, 1,600 favorable. So if you add it together, you will have unfavorable variance of 1,700 unfavorable plus 1,600 favorable for 100 unfavorable. Just to let you know, if you understand what I have told you on these last two examples, basically the chapter is over. You can probably go back to your McGraw-Hill Connect and do the problems. And I can show you that also, one or two of them. Any question on this or this? Again, as I said, make sure you write down the formulas and fill in the numbers. That's it, guys. There are just two formulas here. The same thing will happen with the overhead rate. Or I'll give you a break. Means since it's a similar, I can skip the overhead part. Just do the two. Let me see if I've given you any questions on the overhead before I say that. Sorry. Let me check that first. Okay. Because I've got time to cover, so I can cover it. It's not a problem. What I'll do is I'll do the overhead in the next class. I'm not going to do it today. Okay. I think it's enough for today. Let me just show you one problem on it, and then we should be good. I still have about 4 minutes, right? Nice. Flexible budget you can deal with. So here is basically the problems for the material variance, direct material price variance and the quantity variance. So again, try to do this on your own. Try one of the problems to do the direct material price variance and quantity variance. See if you can match the numbers, please, quickly. Write down the formula and the answers. See if you can do it.
What's the problem number?
Number 721-8 QS. When you go back, means you are at home, definitely try one or two problems. It will take you 10 minutes, but it will basically firm it up right now. Otherwise, later on, when you try it, it'll take you more time. Just after the class, just spend 10-15 minutes on finishing the problems, one or two problems. And do it for all the chapters, basically, so that you don't have to worry about it. So right here, we know that the actual price is 170, standard is 2. So we paid less than actual. So this will be a favorable variance. So that's the first part of it. 30 cents for every hour, or sorry, for every unit. 310,000 units times 30 cents gives you 93,000 favorable. So I can just check it like that. Same thing here. You were allowed 210,000. You used 310,000, so this is unfavorable, obviously, for 100,000 units at $2, 200,000. So
Okay, I have a question. Where did you get the 170 from?
170. Your cost of direct material use is 527,000. Your direct material used are 310,000. So 527 is the total cost you spend for 10,000 units. Okay. If you spend $200 for 10 pizzas, what's the cost per, let me make it 20. So what's the cost per pizza? Hello? Hello, what's the cost per pizza?
$20.
20?
$20, right? So that is basically whatever you spend divided by the number of units you bought. So same thing here. You bought, you spent 527,000 and you bought 310,000 units. Okay. Does that answer your question?
Yes, thank you.
Okay, welcome. Any other question on this problem? Means other problems are basically similar. It's nothing very different. Yeah, I'm just checking to see if I've given you any overhead problems or not before I cover it. I don't think I've given you any overhead problems. Oh, here it is. It's not bad. You don't even need anything for that. Okay, here is the, so we can, I think I'll just let you skip that. So now here is for the rate for the labor. Again, the same formula, if you notice for the labor rate, you got actual hours, actual rate, standard hours. So same thing. Your actual rate is 16, your standard is 15. So you paid $1 more. So your variance for the rate will be unfavorable for 68,000 hours. So $1 times 68,000 gives you 68,000 unfavorable. Over here, you have 69,200 hours allowed. You use 68,000 hours, so you use less hours than were allowed. So the variance is favorable for 1,200 hours at $15 an hour for $18,000. That's about it. So guys, you have to do the practice now, which means there's nothing more to be done, at least concept wise, if overhead doesn't need to be covered. Okay. Have a nice day, everyone.
You too. Have a nice weekend.
Thank you.
You too.
Thank you. And please bring your questions on Tuesday. That is 27th, right? No, sorry. 30th. And we'll do some more practice on these problems and then wrap this chapter up, move on. Or do you need a study day on Tuesday? I assume no. Then I'll see you on Tuesday, the 30th. Have a nice day, everyone. Any questions?